Good afternoon, ladies and gentlemen. We got our CPI data, our PPI data. We are heading into Friday where we get consumer sentiment. On today's Stock Market Brief show, we're going to dive into how the market took in that information. We're going to dive into the conditions of the market as where we stand, and then also look into what the Fed here watch tool is telling us from a probabilities perspective of rate cuts and what has happened in the past when Feds cut rates. Let's get into today's episode. All right, people, welcome back to the show. So we did get our CPI data today, and it came in as expected. Consensus for inflation rate year over year was 2.9. It came in at 2.9. For the core inflation rate, consensus was at 3.1. It came in at 3.1. So this was not hotter than expected. It is worth noting, what was the previous inflation rate year over year? It was 2.7, which means what? Inflation has moved higher, but yet it was in line with expectations. And the market took this information and ran with it. The Dow was up 1.36%. The S&P 500 was up 85 basis points. The NASDAQ up 72. The New York Stock Exchange 1.1. And in our small caps did incredibly well, and mid caps 2% on the day. Out of the 11 sectors, everything was in the green. Materials and consumer discretionary led that way. Saw some big moves in Tesla. But what is the Fed probabilities telling us now? Now we're locking in, yes, 100% probability of a rate cut come on September 17th. There is an 84% probability that we are going to see another rate cut in October, and then a 80+% probability, right? 78 plus 6 over here, over an 80% probability of another rate cut. So the market really did rally today on the back of potentially even working on a fourth rate cut for the year. Now, this is with rising inflation, which we saw the uptick in, and also weakening jobs data that we saw. So interesting times overall there. And this happened to take place, we'll talk more in the market conditions section, in a highly liquid environment in positive gamma. And this type of stuff makes sense where volatility is suppressed at these levels. They buy the dip, they sell the rip, and so forth. We've been discussing that for many videos for a while now, diving into that. But what I want to talk about here is the last time the Fed cut rates. Remember, on the last video, we talked about, hey, in 2017, Trump's first year in office, we saw the 10-year yield go down like this. And then from middle of September to October, it actually found some sort of a bottom and started rallying. Well, the last time we had a Fed cut, which was September 2024, it actually followed this path that you're seeing in red. And the reason why I want to call this out, at least right now, is because from a seasonal perspective, and then also from just the last rate cut, when they cut rates, the 10-year yield actually rose, which is very interesting because if this happens again, it's not to predict that it's going to happen, but if it were to happen again, well, what do we need to know? We need to know what is negatively correlated to the 10-year yield. If it starts moving higher for whatever reason, if there's things that are negatively correlated to it, those assets can be affected. Okay, if we continue on and look at the US dollar, the 10-year yield, right? The 10-year yield, we've been talking about how this has been falling. The dollar has kind of been going flat. And the S&P 500 has been going up. So we already know that when these things happen, at least in this current market environment, they're falling. That is very beneficial for the S&P 500. In the last video, we talked about this briefly. We went into the dollar, or sorry, not last video, the video prior to that. This is the rolling 20-day period correlation that the 10-year yield, which is right here as it kind of broke down lower, these lower highs, boom, crack lower, a little bit lower today. These are the correlations of various assets that it's currently at from a 20-day perspective. The S&P 500 minus 0.81 now. That's a pretty negative correlation, meaning that the 10-year yield rises. There's a high possibility that the S&P 500 goes down, consolidates, and so forth. NASDAQ 100, 0.63. We got IWM at 0.83 over here. Bitcoin, basically no correlation. It's positive 0.23, pretty flat. Housing index, negative correlation of 0.85. KWeb, 0.84 negative. So these are some pretty deep correlations. In fact, I have a chart of gold miners, which I guess I wasn't planning on talking about it, but I have the charts on this deck. So I'll walk you through the gold miners correlation too, because that's in the 90s of negative correlation, meaning that those can get affected clearly if the 10-year yield rises. Overall, the S&P 500 did hit into new high territory, closed at a new all-time high, right in and around that 6,600 it came in contact to. We still have a negative divergence building, and we're still within this bullish channel as it stands right now for the S&P 500. If we take a look at market conditions, it was 5,500. What is our call wall? It was close to 6,600. We were mentioning how it's a high liquid environment, how you can be bullish above 5,500, be more cautious below. Okay, well, we got through the 6,550 when we came into 6,600 today. We came close to it. We didn't quite tag it yet. So if you want to look for that tag, it looks like, I mean, we're right there. It's a stone's throw away. So let's at least go for it. At this point, then you want to see if traders continue to reach out further. As it stands right now, we have a massive level here, so it's going to be hard to really break extremely far from this. If nothing changes, it'll come right back in, or it can act as a potential level of resistance or some sort of a pin. When I look at the net gamma history, you can look back. This is a pretty high level dating back. I mean, it's the highest we've been. I can't go back further on this chart, but sometimes when you get these very massive amounts of gamma, this is typically where you can see minor reversals or periods of consolidation as well. If we look at back month versus front month volatility, this is kind of interesting stuff, so pay close attention here. Back month versus front month volatility, it is still extended above that 20%. This is where we see consolidations, where we see pullbacks, etc. But Mike, we've been going sideways, but now we're breaking up higher. And yeah, this is still rather elevated. So I wanted to point out, remember over here in 23, right in this area, I'm going to just actually draw a box. What did we do in 2023? So this area we consolidated. Okay. Then this area we broke up higher. Okay. So we broke up higher here. Now, what I find so interesting about this area, did we correct? No, we went sideways a little bit, but then we, squeezed higher. And then we went into a 10% correction. Now, this in and of by itself is very hard to determine that we're going to go through a 10% correction. I can't just be like, oh, it happened here. Now we're going through a 10% correction. But what I did find interesting was looking from a systematic standpoint, what were we doing back then in 2023? Remember, we said CTA positioning, it's at kind of an exhaustive level. That means that if we start selling and these guys become selling, they don't care about anything other than really volatility and going with the trend, these commodity trading advisors. You can see that was that 10% correction. See that red line? These charts were provided by Tier 1 Alpha, by the way. I'm not sponsored by them by any means, but my charts weren't loading, so I'm pulling them from Tier 1. If you go back over here to that 10% correction, that red line, that was the S&P 500. What do you notice? Where were CTAs right there at that high? They are right here where we are now. So why am I pointing this out? Is because this 10% correction, you can say, was very well helped out by the movement there, the selling pressure added, and it was, I don't know what I'm trying to say right now. I'm losing my track of words here. CTA positioning really did help on the sell side activity there. That's not it. Vol control funds. Okay, let's go back to 2023. This is that 10% correction, the one that we just called out over here. Okay, this 10% correction right over there, how it kept on squeezing a little bit higher. What was the vol control funds? Where were they at that particular point in time? They are right over here at a high level after what? Coming from a low. So coming from the 2023 bottom or 2022 bottom, boom, it helped drive asset prices higher. Okay, here's April, right? Bottom of the S&P 500. What helped drove it higher? Not only CTAs, but vol control funds. We talked about it down here when we said when these become buyers, it can really help drive flow. So once again, I'm just here reiterating what I say because these things do matter. Maybe not right now in this current moment, but when they matter, it's good to know why it's happening, where it's coming from, and then continue to watch it for when opportunities come back. So yes, the market, once again, it's above the gamma flip line. That's positive, okay? Good stuff. That means vol is typically suppressed. However, I don't have the gamma flip line in front of me right now, but the gamma flip line, unfortunately I don't have it, so I'll post it in my Discord in the morning. So sorry, I apologize, I don't have that chart. And we're clearly above it right now. I know that we are. when we are above the gamma flip line, volatility is suppressed, right? Dealers buy the dip, they sell the rip, buy the dip, sell the rip, and so forth. You get a lot of small up days, okay, driving up days, and then when all of a sudden volatility kicks in, you get one day that wipes off multiple days of damage, which in theory is kind of what we've been seeing. We actually saw this go into negative gamma, and I think this day over here, and you can see it was one day down, then we're above the gamma flip line. It was just small days up. Then we get down, right? Boom, small day down, boom, 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 boom. It's if we stay in that negative gamma regime, and if these two players over here, right, systematics or fall controls or CTAs start becoming sellers, it could become much more aggressive. So what does that mean for you? What does that mean for me? What am I doing? It means that my cash exposure in my portfolio is growing, but I'm still taking on good looking setups because bubbles can bubble for a very long time. So you want to be a part of it while it's moving higher, and then just be very diligent at taking risk or trimming risk, you know, and putting stops in place and so forth. What you don't want to have happen is if the market gets hit and it gets hard and you just like try to like make it back very fast, but yet things may be shifting, right? So it's very important to know when these market conditions change when we see this stuff happen. If I look at the expected moves, today we came into the upper eyeball range. You can get these levels from the Astrobot in the morning. I'm going to give you the updated one, but we came into that today and we doodled around. We are clearly outside of the weekly implied move. We're right there at the upper weekly zone, right? This is the weekly zone. This is the weekly Astrobot range. This is based off of the options market over here. And so it was tagged, right? So are we way outside of expectations with the data that we've been seeing? No, the PPI data, the expected move for PPI was right here. We came into it and then it started moving lower, kind of, you know, selling off into the CPI report. CPI report came out. Bam, where do we come? Right into the daily implied move, basically closed right there. And we're right outside of the weekly implied move as it stands. So the market's well within expectations. We'll see what Friday brings. It's very typical to see the market doodle around, but we'll see if there's a little bit more juice in the tank. If it does start to press higher, keep an eye on 6,600, right? That can act as a level of resistance. It can act as a pin. The updated daily implied move going into tomorrow can bring us up to around 661 to 662, which is right there by the quarterly expectations of the market, which is yet to be tagged. And then we also have the lower daily implied move down here at about 654 down to 652. If we were to come off here, you know, people will probably freak out, but really what would that be? In the short term, we'd still be above a rising 5-day, we'd still be above the gamma flip line, and we'd still see a series of higher highs and higher lows. So just be aware of that. We're in this kind of phase where we get these type of movements. It's very normal to see this type of behavior, and you just got to manage risk at a higher level and be aware that when things change, when things switch, it can get crazy. It could get crazy quick. And I know I've been saying that because that's what I do here. I prepare people. I look at these key levels. I don't have my, you know, my performance for this month or for this year to show display right here, but I am sending it over to the United States Investing Championship where you can see that. And then I'll share maybe on the next video what my curve looks like. And once again, just explain to you how I'm kind of navigating this overall in these current conditions. That's all I got for you. Hope it helps out, and I'll see you on the next.